The PE ratio, arguably the most popular ratio and valuation metric in the business world, is a very simple one. What is it? It is P over E, where P is the price you pay and E is the earnings you receive. This simple ratio can be used to analyze almost every single business in the world, both in the stock market and outside of the stock market. Now, why is it important? It tells us how much you, the investor, are paying for an asset that produces a certain level of income or earnings. In its simplicity, enables us to put all companies of size and industry into a gauge or scale for better understanding and information. Forget the complications of the stock market for a second. Let's have a simple example, such as real estate with two investment properties. P is the price of the home and E is the earnings or rental income you earn on the home. Let's assume there are two houses that are the same in every respect, being size, location, quality, age, etc. House A is worth $100,000 and earns $10,000 in rental income. The PE ratio tells us that P, or the price, is $100,000 and E, or earnings, is the $10,000 in rental income. PE, $100,000 over $10,000 tells us the PE ratio is 10. A PE ratio is used for comparability, so a PE ratio in and of itself doesn't actually tell us much. Analysts, business people, and investors use the PE ratio to compare the asset, often to similar assets in the market, or to the market as a whole, if you want to take a more broad approach. So we have house A. What about house B? Well, let's say house B is again selling for $100,000, but this house earns $20,000 in income. Well, $100,000 over $20,000 tells us the PE ratio is 5. Now, assuming nothing is wrong here and there's no catch, we can infer that house A is overvalued relative to house B, or subsequently house B is undervalued to house A. Let's say there's a real estate market, and after gathering and deriving all important data, we see that the average PE ratio for this housing market is 5. Then again, for comparability's sake, we can say that house B is actually fairly priced relative to the market, and it is house A that is overvalued. The profit-seeking investor may short this asset if available, and will probably stay away from the asset B given that it is fairly priced. In the stock market, the PE ratio is often expressed on a per-share basis. This essentially tells us how much you're paying for the earnings that a company makes. Now, don't be confused. A per-share basis is no different than the total. P in the PE ratio in the stock market is the price of a single share of the company you are buying. So when Amazon is selling for $2,000 a share, P is $2,000 for Amazon, and E would be the earnings it makes on an annual basis. However, the PE ratio, when looking at it on a per share basis, can easily be transferred over to the PE ratio on a whole company basis. What's the difference? The only difference is the shares. So the price per share divided by the earnings per share is the same as the price of the company divided by the earnings of the company. If you want to look at it at a per share basis, let's say the company earns $1 per share, has 1 million shares outstanding, and its shares sell for $10 on the market. This would tell us that the PE ratio is 10. At the same time, if you want to look at the price of the whole company, this would be the price to buy the company. And given that shares are $10 each, and there are 1 million of them, you'd have $10 million as P for the price of the whole company, and the earnings of the company would be the earnings of the whole company, which would be $1 per share multiplied by 1 million shares outstanding, which should be $1 million in income or profitability. The PE ratio in this case would be 10 million over 1 million, again, which is 10. The PE ratio, in other words, doesn't really look at the price of the company because the earnings of the company often increase as the price of the company goes up. And this is important to consider, especially for the amateur or beginner investor. The amateur or the beginner investor often looks at the price of a company on the stock market, and looking solely at the price may reach a false conclusion as to overvalued, undervalued, etc. The price of the stock of a company in and of itself essentially tells you nothing. A company's shares could be selling for $1,000 on the market. At the same time, a company could be worth $10 a share on the public markets. But if it's only earning 10 cents a share, that's a PE ratio of 100. In other words, that would be a very expensive stock. We hope this has been informative, guys. We want to thank you for watching, and once again, happy investing.